Hi, my name is Rachel Bauer, and today we are going to talk about the finance simulation capital budgeting. And today I'm going to try and tell you how I kind of made the decisions that I made. So to start off with, my company, for the new Heritage Doll Company, this is my financial overview of kind of how I did throughout the whole company. And my company APV was 549.64, which I don't think was terrible at all. Actually, I think it's pretty good, but there's definitely always some room for improvement. So if we take a look over here, you can see that my revenue from 2009 to my previous and then my current has steadily increased from 245 to 333 to 348, along with my operating income steadily increased and my net income as well. And that these little bars over here show that I actually did better than what the simulation projected me to do. So if you take a look at the pie chart, on this one you can see my revenue by division. You can see that I made most of my revenue in my retailing and my production. I did more with my retailing. And then if you look at my operating profits, you can tell that most of it is from licensing, and then I have production and retail. And then my assets come from mostly my production, and you can see that my revenues are steadily increasing over here as well. Here for a little bit they kind of stayed stagnant, but for the most part they increased. So how I made most of my decisions actually was through my project updates. And if you go click over here, it'll take you through all of my updates. 2009 was actually a very good year for me. The new film was released on schedule, the marketing campaign was very successful, and the DVD sales exceeded the ones of the previous films. The retail store expansion in the Northeast generated more revenue than expected and were profitable right away. In the Match My Doll clothing line, a celebrity's daughter was actually photographed wearing the item shortly after it came out. Gross margin was higher than expected due to lower anticipated and raw material costs. So 2010 was also a good year. The toddler doll accessory line went well. In both sales and costs, and the expansion the expenditures of the concept were 3 times higher than projected. However, revenues were likewise much higher than expected, so the local managers are now looking for ways to speed up. So with these 2 good years, I decided to make a few more risky investments in 2011, which backfired on me a little bit. The video game, the response suggests the project will underperform, but it's still expected to be positive. The acquisition of the electronic toy manufacturer was, I believe, one of those that you could only select once, so it was a high risk. The business is profitable but performing below the investment case, so a few of the distributors declined to renew contracts, which they project the future sales growth will be threatened. And then the Dolls of the World initiative, the prototypes took longer than expected, which delayed by several months and caused us to miss an entire holiday season. But if we get it back on track, it's expected to succeed. So after the risky year, I decided to go in 2012 with only one project. The Match My Doll clothing line, we expanded on the one down here in 2009. It benefited from the strong performance of the initial one and has outperformed projections, so that was a good year. And then in 2013, we went with the Design Your Own Doll. The project costs were as budgeted, but were not sufficient to get the assembly and equipment and related software working properly. Additional outlays were required to complete the project, and the launch is delayed. So if you go up here to project details, you can look at everything in a little more depth. So if you go here, under my previous projects, these are the ones that I did select, and under the available projects are the ones that I did not select due to lots of different reasons. So if we go here to the new doll film, we can take a look. My discount rate was pretty average. It wasn't very low. It was a medium risk that I made in 2009. The costs for 2015 were nothing, and the lifetime project costs were low. So that was a key decision and a key thing that I made my decision on. I also spent a lot of my time looking at the IRR. As you can see here, it was very high, which means I was projected to get back more than enough money to cover the costs. And my payback period was low, which was also something I spent a lot of time looking at. Because the lower the payback period, the faster you get your money. So if we look at the Match My Doll clothing line, we can take a look a little bit more. The discount rate was a little higher. The risk was still medium. The lifetime project costs were a little bit higher. And the IRR was not as high as it usually is, probably because the payback period is also higher. And if you go down here and you look at your net income, you can tell it was a good decision because my net income is steadily increasing by just a little bit throughout the years, as well as my depreciation coming to my total also steadily increasing. And then if you take a look at my ending cash balance, you can tell it's increasing here as well. So if we come up and take a look at our income statement and our balance sheet, you can tell that most of my decisions were pretty good because my net income increases, as well as my net sales are also steadily increasing for the future projections, because this is my current year. Along with everything else, everything seems to be looking good, and it seems like I made a lot of good decisions. So we can come back up here and take a look at our dashboard to see how all of the numbers correlated with these charts. And my APV was 549.64. So thank you for watching.